How is real estate valued? As a real estate investor, it's important for you to understand how buyers, sellers, brokers, and lenders and appraisers are looking at and analyzing property. It has a big impact on you. So in this video, I'm going to walk you through the 3 methods of valuing real estate. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. I'm Seth Ferguson. Let's get right into it and talk about real estate valuation. The first method of valuation we are going to cover today is what's called the comparable approach. Say that 5 times fast. Now, some people call this the direct comparison method, but how I learned this, it was called the comparable approach, so that's what we're sticking with today. Now, the comparable approach is very common in residential properties, and I'll put a link right up here to a video I did just talking about the comparable approach. But for today, I'll give you the broad overview, but definitely check out that video if you want to go more in depth. So let's say we have a street right here, and we'll call this any street in any town, and we have a number of properties on the street. And this is the subject property right here. So this is one we're either looking to refinance, buy, sell, whatever it is. We have to determine what the value is of this property using the comparable approach. So this property here is a 4-bedroom, 2-bath. This one here is a 3-bedroom, 3-bath. This one here is a 3-bedroom, 3-bath. And our comparable property, our subject property, sorry, is a 3-bedroom, 3-bath. So following the comparable approach, we have to find an apples to apples comparison. Whether it's on the same street or in the same neighborhood or in the same city, it's all going to depend on how prevalent that type of property is. But for this example, we need to value this 3-bedroom, 3-bath property. So we're going to X out the 4-bedroom, 2-bath. That is not an apples to apples comparison. But we have a 3-bed, 3-bath and another 3-bed, 3-bath. So we're going to use these 2 properties to find the value of the subject. So let's say this one here sold for $500,000 last month, and this one here sold for $520,000 a month ago, and the market's relatively the same. Well, by using the comparable approach, apples to apples comparison, this one sold for $500,000, this one sold for $520,000, and the subject property is very similar to these 2. So our value is between $500,000 and $520,000. Now, one of the drawbacks of the comparable approach is, let's say we are renting out this property, we are generating rental income. The comparable approach does not reward us for generating better NOI, better cash flow. So whether this property is generating $1,000 a month, $2,000, $3,000, you name it, the comparable approach does not look at income produced. It just looks at the value of the comparable properties. So this is one of the drawbacks, and that's why we're going to look at number 2, which is called the income approach. Now, if you are a fan of the channel, I mentioned the income approach quite a bit, and I'll put a link right up here to a video I did going in depth on the income approach. And the income approach is used in commercial real estate. The reason is because we have the issues with the comparable approach here, where we are not rewarded for the income, the cash flow produced. Commercial real estate is all about buying a business that's actually tied to real estate. It just happens to be tied to real estate. And what matters most in acquiring or valuing a business is the cash flow, the NOI, the net operating income produced. And I'll put a link right up here to a video I did explaining all about the NOI, the net operating income, and how you can find that. So what the income approach does is it assigns a value to every dollar of NOI, of net operating income, the property produces. So investors will actually pay X amount for each dollar the property yields or produces in cash flow. And the formula is very simple. So the value equals the NOI divided by the cap rate. Now, definitely check out that other video. I'll go more in depth and explain everything you need to know about the income approach there. But the benefit of this approach is that we are rewarded for producing more net operating income. So if we do a better job at improving rents and optimizing expenses, the market rewards us for doing a good job. We are not reliant upon a property down the street selling at a certain price. We can now take it upon ourselves to have an impact, have a direct impact, and improve the NOI of our property, and the market will reward us because the market is rewarding NOI, cash flow produced with the income approach. And last but not least, the third method of valuing real estate is what's called the cost approach. Now, what the cost approach does is we're going to take a look at how much it would cost to actually reproduce the property, build it from scratch again. And then, so let me write this down. So cost to build. And then what we're going to do, once we figured out how much it's actually going to cost today to build the exact same property, so exact same colors, exact same finishings, exact same setup, everything is exactly the same, but instead of being built, let's say 20 years ago, if it's a 20-year-old property, how much would it cost today to replicate? And then what we're going to do is we're going to factor in depreciation for age, state of the property, that sort of stuff. So now we have to play around with the numbers to figure out, well, okay, it's going to cost X amount to build today, but the property is 10 years old, so how much do we have to knock off the price to account for that? And then last but not least, using the cost approach, we have to factor in land value. Land, of course, if you're a fan of the channel, does not depreciate. So we're going to figure out how much it's going to cost to build the structure, then make some allotments for depreciation, for age, wear and tear, condition, that sort of thing. And then we add the final land value. What's the land worth that the structure is sitting on? And by using this approach, it's called the cost approach, this is how we can then determine the value of the property. Since this is a multifamily real estate investing YouTube channel, we do use the income approach most often, but that does not mean we ignore the comparable approach. We actually do compare properties when we're dealing with commercial multifamily property, whether it's for valuation or whether it's for rent comparables. If we're looking to figure out what market rent is or what we could achieve if we're acquiring an underperforming asset, well, if another property is very similar, and it has 2-bedroom units and some 3-bedroom units with similar amenities, and they're charging an extra $150 a month. Similar areas, we're doing checking all the boxes that we would using the comparable approach for value of the property. We do the same thing looking at rental comps. We go down the checklist, figure out what that property has compared to the subject property, our property in this case, and we work out, well, okay, well, it's very similar, so we should be able to achieve similar rents. That's how we use the comparable approach when it comes to rentals. So that is real estate valuation in a nutshell. And if you are interested in learning more about real estate investing, multifamily investing, join my free Facebook group, link down right below. We have mastermind sessions every month. Great group of people, always happy to help out. And if you do like this video, if you did like it and you found it useful, hit the like button, leave a comment, let me know what you think. It really helps out the channel with the algorithm and all that sort of stuff. And until next time, happy investing.